In 2024, Fidelity counted 654,401 millionaires in America, record high. These are not lucky people. They are disciplined people, the ones who maxed out every year, captured the employer match, and let compound growth do the work over decades. And a meaningful number of them are quietly walking into a tax situation they never saw coming. Most people assume that contributing more to a tax-deferred account is always the right move. The math seems obvious. Defer taxes now, pay less later. But for disciplined, consistent savers, that assumption has a quiet expiration date. At a certain account size, the strategy that built your wealth starts working against it. So why does doing everything right eventually backfire? That is what this video is about. There is a specific threshold where maxing out your traditional 401k stops being optimal and becomes actively costly. Most people never see it coming because nobody tells them to look. And the longer they stay on autopilot, the harder the landing gets. My name is Alex, and if you have ever watched your retirement balance climb while your tax exposure climbed right alongside it, pay attention to this, because the account structure that protects you at 30 can quietly trap you at 65. I'm going to show you exactly where the math breaks down and how to restructure before it does. Once you understand this, you will stop measuring retirement success by how much you contributed and start measuring it by how much you actually keep. The place this starts going wrong is something most investors never question: the autopilot trap. Here's a question worth sitting with for a moment. If contributing more to your retirement account every year is universally good advice, and for most of your career it genuinely is, then at what point does it stop being true? That is not a rhetorical question. There is an actual answer, and it has a number attached to it. The conventional wisdom on the traditional 401k, your employer-sponsored, tax-deferred retirement account, goes something like this. Contribute as much as you can, defer your taxes now, and pay them later when you're retired, and presumably earning less. It is clean logic. It has worked for millions of people, and for the first decade or two of your career, it is almost certainly the right move. But here's the part that does not make it into the brochure. If you are a disciplined, consistent saver, the kind of person who maxes out every year without thinking about it, that strategy carries a built-in assumption that quietly falls apart the more successful you are. The assumption is that your tax rate in retirement will be lower than your tax rate today. For a lot of high savers, that assumption is simply wrong. Not slightly wrong, structurally wrong. And the longer you go without questioning it, the more expensive that mistake becomes. Think about what actually happens when you max out a traditional 401k year after year. This year, the IRS limit is $24,500. You are deferring that amount from your taxable income now, which feels like a win. But that money does not escape taxes. It delays them. Every dollar you put in is a dollar the IRS has a future claim on, and that future claim grows as the account grows. Here's where it gets strange. For someone who starts contributing aggressively in their late 20s or early 30s, by the time they hit 65, they are not sitting on a modest nest egg. They are sitting on a very large tax-deferred account. $1 million, sometimes two, sometimes more. And every dollar in that account will eventually be taxed as ordinary income, not at the favorable long-term capital gains rate, but at the same rate as a paycheck. Let me give you a concrete example. The software project manager named Kevin starts maxing out his traditional 401k at 32. He earns around $115,000 a year, puts away the full annual limit, and his employer matches 3%. He has been doing this consistently for 33 years. At a 7% average annual return, Kevin walks into retirement with approximately $2.3 million. He feels great about that number. He should. But here's the problem Kevin did not see coming. That $2.3 million is not really his. Not entirely. It is his and the IRS's. Every dollar that comes out of that account in retirement will be taxed as ordinary income at whatever rate applies to his total income that year. And the larger the account, the larger the annual withdrawal the government will eventually require. Kevin deferred his taxes successfully for 3 decades. What he did not realize is that deferring taxes on a growing balance is not the same as reducing them. In many cases, it is the opposite. The mechanism that forces this issue, the thing that turns a large tax-deferred balance into a mandatory tax event, whether Kevin is ready or not, has a specific name and a specific trigger point. Understanding exactly how it works is what changes the math completely. That is the RMD tax bomb. The IRS does not ask nicely. Most people picture retirement as the moment they finally get to decide what to do with their money. What they do not picture is the government stepping in with a mandatory withdrawal schedule and a tax bill, whether they need the cash or not, whether the market is up or down, whether the timing works for them or not. That is exactly what a required minimum distribution is. An RMD, required minimum distribution, is the amount the IRS forces you to pull out of your traditional 401k and other tax-deferred retirement accounts every single year once you hit a certain age. Currently, that age is 73 if you were born before 1960, and 75 if you were born in 1960 or later. The IRS has been patient for decades, watching your money grow tax-deferred. At that point, the patience ends. The math is straightforward. The IRS uses something called the Uniform Lifetime Table, a life expectancy divisor assigned to your age each year. At 73, that divisor is 26.5. So you take your account balance at the end of the prior year, divide it by 26.5, and that is the minimum you must withdraw every year, without exception. Here is what that looks like in practice. A retired logistics director named Sandra spent 30 years building a traditional 401k. She was meticulous about it, contributed the max every year, reinvested dividends, never touched it. She retires at 68 with $1.8 million sitting in her tax-deferred account. She does not need the money yet. She has a pension and some savings. But at 73, the IRS does not care what Sandra needs. Her first required withdrawal is $1.8 million divided by 26.5, roughly $67,900. That amount comes out and gets taxed as ordinary income, not capital gains, ordinary income. Sandra is now in the 22% tax bracket before that withdrawal even hits. After it does, she is looking at the 24% bracket. That one mandatory distribution just cost her approximately $16,000 in federal tax on money she did not ask for and did not spend. And that is only year one. The divisor shrinks every year. The percentage she is required to withdraw grows. So does the tax bill. But here is where it gets genuinely dangerous for disciplined savers, because the RMD does not exist in isolation. It triggers a chain reaction. That forced withdrawal stacks directly on top of Sandra's Social Security benefit, and once combined income crosses a certain threshold, up to 85% of her Social Security becomes taxable too. Then her total income nudges past $109,000, which is this year's IRMAA threshold for single filers. IRMAA stands for Income-Related Monthly Adjustment Amount, and it is a Medicare surcharge that kicks in the moment your income crosses that line. Her Medicare Part B and Part D premiums jump, not by a little, potentially by over $1,000 a year, and she cannot appeal it because the surcharge is based on her income from 2 years prior. Think about that sequence for a moment. One forced withdrawal, no spending decision, no lifestyle upgrade, and the result is a higher tax bracket, a larger portion of Social Security subject to tax, and a Medicare surcharge arriving 2 years later, like a delayed consequence she never saw coming. This is what I mean by the compounding tax cascade. It is not one bad thing happening. It is one bad thing that causes 3 other bad things, each of which makes the next one worse. Sandra did not make a mistake. She saved diligently for 30 years and got rewarded with a tax problem she never anticipated. Now, you might be thinking, what if I just look at the fees inside my plan while I'm still working and try to minimize the damage there? That's actually a very good instinct, because before RMDs ever become your problem, there is another force quietly draining your account from the inside, and most people never see it leaving. That is the hidden fee drain. Nobody sends you a bill. That is the thing about investment fees. They do not show up as a line item on your statement. There is no invoice, no deduction you can point to. The money just quietly disappears from your returns before you ever see them, month after month, year after year. And because you never feel it leaving, most people never go looking for it. Here is why that matters. The RMD tax bomb we just walked through is a retirement problem, something that hits you decades from now. The hidden fee drain is happening right now, inside your account, every single day you stay on autopilot. Let me show you the math. 2 colleagues work side by side at the same company. Both are dental practice managers. Both earn roughly the same salary. Both contribute $10,000 a year to their 401k for 30 years and get a 7% average annual return. The only difference is where they work and what their plan charges them. The first one, call her Patricia, works for a large regional hospital group. Her plan is well negotiated. She pays around 0.4% in total annual fees, which is actually close to what you would expect from a large employer with significant bargaining power. After 30 years, Patricia's account grows to approximately $940,000. The second one, call him Ray, works for a small private practice with about 20 employees. The plan administrator is not exactly shopping around for deals. Ray pays 1.4% in total annual fees, which, according to current industry data, is completely typical for small plans. Plans with under $5 million in assets routinely run between 1 and 1.4% annually. After 30 years at the same contribution rate, same return, same everything, Ray ends up with roughly $750,000. That is a gap of nearly $190,000. Sit with that for a second. Ray did not make worse investment decisions. He did not earn less. He did not contribute less. He just happened to work somewhere with a less competitive retirement plan. And that one difference, 1% per year in fees, silently siphoned away nearly a fifth of his retirement wealth. Not in a bad year, not in a crash. Every single year, in good markets and bad, that money was leaving. Here's what makes it worse. Because the money was never removed as a visible deduction, Ray never thought to ask about it. His statements showed growth. His balance climbed. Everything looked fine. The fee was not stealing his money in a way he could see. It was stealing his compounding. And compounding, once lost, does not come back. Every dollar that left as a fee was a dollar that could not grow into $2, then 4, then 8. The damage compounds in reverse just as powerfully as growth compounds forward. Now you might wonder, what can you actually do about this? The answer is more than most people think. The first step is just knowing what you're paying. Your plan's fee disclosure document, which employers are required to provide under federal law, will show you the total expense ratio for each fund you hold. If you are in a large cap index fund and paying more than 0.2%, you are likely overpaying. A comparable fund in a well-run plan might cost you 1/10 of that, or less. Vanguard's average expense ratio across its funds is currently around 0.06%. Some index funds inside large corporate plans cost even less. If your plan fees are high and you cannot change plans, you have a few levers. You can shift your contributions toward the lowest cost funds available inside your plan, often a basic index fund. And you can look at whether rolling over old 401k balances from previous employers into a lower cost IRA makes sense. You are not necessarily trapped, but you have to look first. The uncomfortable truth is that most people spend more time comparing prices on a TV than they do checking the fees on an account that holds their life savings. That is not a character flaw. It is just what happens when costs are designed to be invisible. But fees, at least, are a problem you can investigate and partially solve from where you sit today. The next problem is harder, because it is not about what your account is costing you. It is about what your account will not let you do. That is what happens when a 401k stops being a vehicle and starts becoming a liquidity cage. There is a version of financial success that looks great on paper and falls apart the moment life stops cooperating. You have probably heard the term asset rich, cash poor. It usually refers to homeowners who have most of their net worth locked in property they cannot easily sell. But there is a retirement version of the same trap, and it is far more common than people realize. You can have a 7-figure account balance and still be functionally broke, because the money is there, but you cannot reach it without paying a serious penalty to do so. That is the liquidity cage, and the people most likely to fall into it are not the ones who saved too little. They are the ones who did everything they were told. Consider a construction project manager named Vincent. Vincent was methodical about money in a way most people are not. Starting at 33, he maxed out his traditional 401k every single year. He lived below his means, avoided lifestyle inflation, and reinvested every raise. By 53, he had built a traditional 401k balance of just over $1,100,000. On paper, Vincent is a millionaire, comfortably so. His liquid savings account, the money he can actually access without a penalty, holds about $14,000. When his company is acquired by a private equity firm and his entire division is restructured out of existence, Vincent has roughly 6 weeks of accessible runway. He is 53 years old, a millionaire by every conventional measure, and he cannot pay his mortgage for 3 months without triggering a tax event. Here is the mechanics of why. Traditional 401k funds are locked until age 59 and a half. That is the IRS rule. Pull money out before that birthday, and you owe ordinary income tax on every dollar withdrawn, plus a 10% early withdrawal penalty on top of that. So if Vincent pulls out $50,000 to cover living expenses while he job hunts, he might net somewhere around $31,000 or $32,000 after federal tax and the penalty, depending on his bracket. He paid full price to save that money. He pays full price again, plus a surcharge to access it early. Now, there are some exceptions worth knowing. The IRS does allow penalty-free withdrawals before 59 and a half under what is called Rule 72T, which lets you take a series of substantially equal periodic payments from your account. There is also an exception for people who leave their employer in or after the year they turn 55, sometimes called the Rule of 55, which allows penalty-free withdrawals from that specific employer's plan. These are real options, but they come with rigid rules, limited flexibility, and they lock you into a specific withdrawal schedule that may not match what you actually need. They are workarounds, not solutions, and they do not help if you have been consolidating everything into a single traditional 401k for 2 decades. This is where the timeline mismatch becomes clear. The traditional 401k was designed around a very specific assumption that you work continuously until roughly 65, then retire and begin drawing down. That model made sense in 1978 when the 401k was created. It fits far fewer people today. Early retirement is increasingly common. Career disruptions, layoffs, health events, industry shifts happen to disciplined savers just as often as anyone else. The gap between when you might need your money and when the IRS lets you have it penalty-free can easily be 5 to 10 years. And every extra dollar you poured into a traditional 401k above the employer match is a dollar that made bridging that gap more expensive, not less. Vincent eventually finds work. It takes 9 months. He drains his savings, borrows from family, and avoids touching the 401k, but only because he had other options. Not everyone does. The real question his story raises is not about emergency funds or cash reserves, though those matter. It is about architecture, about how you build a financial structure that gives you access when you need it, tax efficiency when you want it, and long-term growth throughout. That is not an accident. It requires a deliberate plan. And that is exactly what the 3-bucket strategy is designed to provide. The best financial structures are not the ones that maximize one thing. They are the ones that give you options. That is the core insight behind what we are about to walk through. Everything we have covered so far. The tax problem that builds quietly inside a growing account. The forced withdrawals that arrive whether you're ready or not. The fees that drain compounding you never see leaving. The cage that locks your money away when life goes sideways. All of it traces back to the same root cause. Overconcentration in a single account type. One bucket, one set of rules, one set of risks. The fix is not complicated, but it does require a deliberate decision to stop doing what feels automatic. Clara is 49 and works as a hospital administrator, earning $162,000 a year. She is not in crisis. Nothing went wrong. She simply sat down one afternoon, ran the numbers on her current trajectory, and did not like what she saw. Her traditional 401k balance was just over $800,000. Her accessible savings were thin. Her projected RMDs at 73 were going to push her well into a tax bracket higher than anything she had paid during her working years. She was building wealth efficiently in one direction and creating a serious problem in another, so she made a structural change. She did not stop saving. She stopped concentrating. Here is what she did, in order. First, she kept contributing to her 401k, but only up to the employer match. Her employer matches 50 cents on every dollar up to 6% of her salary. She captures every cent of that. Walking away from an employer match is walking away from an immediate guaranteed return of 50% on that portion of her contribution. That does not happen under any circumstances. Second, she redirected the rest toward tax-free buckets. She is enrolled in a high-deductible health plan through work, so she maxed out her HSA, her health savings account. This year, the HSA limit for an individual is $4,300. The HSA is the only account in the tax code that delivers a triple tax benefit. Contributions go in pre-tax, the money grows tax-free, and qualified medical withdrawals come out tax-free. After 65, she can withdraw for any reason and simply pay ordinary income tax, making it function like a traditional IRA with a built-in medical bonus. From there, she contributed the maximum of $7,500 to a Roth IRA. The Roth grows tax-free. Withdrawals in retirement are tax-free, and there are no required minimum distributions during her lifetime. The RMD tax bomb does not apply to a Roth. It simply does not exist in that account. Third, she built the bridge. Whatever remained after the match, the HSA, and the Roth went into a taxable brokerage account. Not glamorous, but completely accessible at any age, without penalty, without a forced withdrawal schedule. And investments held longer than a year are taxed at the long-term capital gains rate, currently 15% for most earners in her income range, compared to the 22 or 24% ordinary income rate she would pay on traditional 401k withdrawals. That gap matters enormously over decades. Here is something worth pausing on, because it is genuinely significant. The government has started to recognize this exact math itself. Under the Secure 2.0 Act, high earners making more than $150,000 in wages are now required to put catch-up contributions into Roth accounts, not traditional pre-tax accounts. Required, mandated. The architects of the tax code looked at what happens when high earners accumulate massive tax-deferred balances and decided to intervene. That is not a coincidence. That is a signal worth paying attention to. So what does Clara's restructured approach actually produce? She now has 3 distinct buckets working simultaneously. Her traditional 401k continues growing, capturing the employer match and its upfront tax deferral. Her Roth and HSA grow completely tax-free with no future distribution requirements attached, and her taxable brokerage gives her the one thing she did not have before: a penalty-free bridge to any point in time she might need it. She can retire at 56 if she wants. She can cover a career gap. She can choose her own timeline rather than waiting for the IRS to hand her one. That is what tax diversification actually buys you, not just a lower bill. The ability to decide when the money comes out, at what rate it gets taxed, and on whose terms. The question that follows from all of this is the one that matters most, and it is the one we land on now. Here is what this all comes down to. The 401k is not a scam. It is a genuinely powerful tool that has built real wealth for millions of people. But a tool used blindly, past the point where it still fits the job, stops being an advantage. It becomes a liability you did not see coming. The pattern is always the same. Consistent saving creates a large tax-deferred balance. A large tax-deferred balance creates forced withdrawals. Forced withdrawals create a tax cascade that touches your Social Security, your Medicare premiums, and your bracket all at once, all in retirement, all at a time when you have the fewest levers to pull. Meanwhile, fees you never saw leaving have been quietly compounding against you for decades. And the liquidity you sacrificed to build that balance was the exact thing you needed when life did not go according to plan. The mechanism behind all of it is concentration. One account type, one set of rules, one future you did not design. What to watch for going forward is simpler than it sounds. Every time you get a raise, a new job, or a change in your plan, ask where the next dollar should go. Not where it has always gone, where it should go now, given your current bracket, your current fees, your current timeline. The follow-on question worth sitting with is this: if you can control how much taxable income you show in any given year of retirement, how much of the tax cascade we described could you actually avoid? That is the deeper game, and it has a name. It is called retirement income sequencing, and it is where the real leverage lives.